Okay, so the Federal Reserve has three tools of money supply to use. And think of it like being at your home, and if the temperature in your house is just right, you leave it where it is. Well, if it's too hot, you want to cool it off. If it's too cold, you want to warm it up. So think of it that way. When the economy is too slow, they want to speed things up by putting money into circulation. If the economy is going too quickly and they feel like it might be out of control, they're going to take some money out of circulation. Or if they want to control prices, they're going to take money out of circulation to try and get it under control. So the three tools of money supply are open market operations, changing the reserve requirement, and changing the discount rate. Now let's look at each one of these individually. Open market operations. All right, open market operations is the buying and selling of government bonds, bills, and notes. So what they do is they sell these notes that are worth $1 million, let's say, in 10 years. And so the United States government auctions those off. And so they auction off, let's say, for $650,000. So the person or the investor who buys that would give the United States government $650,000, and they would give them a piece of paper that is worthless for the next 10 years. And the United States government, if they take that money and shred it, they just decreased the amount of money in circulation. Vice versa could be true too. They could go back in a few years and buy that note back from that person, and then they would print the money at the printing press, basically buy the bond back from that person, and then throw the bond away. That would increase the amount of money in circulation. Now, this happens every day, all right? So just to clarify, they buy government bonds from the public to increase the amount of money in circulation, and they sell government bonds to the public to decrease the amount of money in circulation. So as an example, let's say the government sells this $1 million bond. This is a fancy piece of paper here, and they auction it off for $650,000. In this situation, a 10-year note, a 10-year note, a 20-year note, all right? So something you buy today, and then in 20 years is worth $1 million, today would go for about $650,000. That equals 2% annual percentage yield. So in other words, that $650,000 is going up 2% per year when you buy it at that price. So that's what open market operations is. It's the buying and selling of these government bonds. Now, the next one is one that's rarely used. It is the reserve requirement. Let me jump ahead here just real quick and see what's next. Okay, the reserve requirement is when you put money in the bank, they divide it into two categories. Category one is they turn around and loan it back out, and that's how the bank makes a profit. When you put money in your savings account for 1%, and then they turn around and loan it out to somebody for 5% to buy a house, that difference is their profit. That's how they pay their bills. It's how they pay their tellers. It's how they make a profit. Well, right now, the reserve requirement is 10%. Okay, give or take 10%. So when you put $1,000 in, they have to take $100 of it and hang on to it, keep it in their vault, if you will. Well, the other $900 gets loaned out. Well, if the federal government changes that to a 5% reserve requirement, now they can take $95 and loan it out, thus increasing the amount of money in circulation. Now, the government rarely uses this tool. It's like an elephant on our teeter-totter. On one side we have jobs, and the way we help out the jobs category is by putting money in circulation. The way we help out the inflation category is by taking things out of circulation. So these two things are on a teeter-totter, and our government is constantly trying to balance those. And what we have learned is changing the reserve requirement is like throwing an elephant on the teeter-totter. And it's way too strong and way too powerful. So we want to try not to use this policy if at all possible. And then the last one is what we call the discount rate. The discount rate is the rate at which banks can borrow money. Banks can borrow money if they need to. And then it's like a domino effect or a trickle-down effect. So if a bank wants to borrow money to give you a loan, let's say, so the bank needs to borrow it because they want to give you a loan for whatever reason, so they can get a loan at, let's say, 2%. All right, that's the discount rate, and that's established by the Federal Reserve. Well, they're going to have to turn around and charge you 5% to pay their bills and still make a little bit of a profit. Well, if the Federal Reserve changes that discount rate to, say, 4%, now they've got to charge you 7 or 8% to make their profit. So when the Federal Reserve changes the discount rate, it dominoes and causes your interest rate to go up. So as an example, let's say you wanted to borrow $1 million and the bank was going to give it to you for 4% because the discount rate was 2%. You say, you know what, I'm going to go home and think about it. And you come back in a week and you say, hey, I want that loan now. And the bank says, well, things have changed. The discount rate went to 4%, or the prime rate went to 4%, or whatever, okay? As a result, you now have to pay 6%. Well, you're not as likely to borrow that money. As a result, you are less likely to borrow the money and go and spend it to create jobs. If they lower the interest rate, that would make you more likely to borrow the money and go out and spend it and thus create jobs. Those are the 3 tools of monetary policy. If you have any questions, by all means, contact me.